exclusive flashes on your screens. Regulatory changes, Supriya, in the offing is what I'm believing, and which could prove to be a bit of a breather, quite a bit of a big breather for the banking space.
Oh, absolutely. And this is a big move that the Finance Ministry and the RBI are together looking at. We given to understand by highly placed sources in the Ministry of Finance that the government is looking to change the restructuring norms for banks. Simply put, it will be done through an RBI circular in the course of the next few days. What we are given to understand is that the RBI and the government together will allow banks to restructure loans for one time for a project's life cycle without making provisions, without actually looking in to provide for that. We're also given to understand that the restructuring will be allowed for projects where the delay has been on account of extraneous factors, on factors like regulatory hurdles, land delay or environmental clearances. We're also given to understand, however, by Finance Ministry sources that the tenure of the debt when it increases amounts to restructuring. Now, through this one circular alone, that increase in tenure of the debt will cease to be restructuring. So the banks will not have to provide for that as well. This will be a big boost to banks' balance sheets. This will be a big boost to, the rising NPAs and the efforts to arrest them. And of course, this certification will be done by a third party. The third party could be an RBI audit committee or a bank's audit committee. This will be a purely commercial decision. But let me tell you here, this is going to be a double-edged ammunition. In one go, the Finance Ministry and the RBI are looking to arrest the rising NPAs for banks to help their balance sheets look better, because this is the time when banks have taken maximum hit on at the cost of infrastructure loans due to various factors. Some of these projects have been delayed. So that's point number one. And point number two is that this will also help projects worth 1.5 lakh crore rupees kickstart and perhaps bring back the investment-led growth that one has been talking about in the Indian economy. So this is a double-edged ammunition. It helps banks to buy more time and perhaps absorb, and it will not impact banks' profits right now. It will perhaps help absorbing the hit that banks will take at a better time than this right now, because the macroeconomic fundamentals, as they worsen, are impacting the banks' balance sheets the most. And many people have voiced concerns that this is perhaps going to lead to a crisis in Indian banking. And this is one such move that is looking to avert that, at the same time also kickstarting the infrastructure space. So this is a big move, a regulatory overhaul of sorts for restructured loans. For a one-time restructuring, there will be no provisions. For the tenure of the debt increasing, there will have to be no restructuring, so to say, so no provisions there as well. This is a big overhaul, and this will perhaps be done through an RBI circular.
Supriya, stay on. I would want to come back to you on questions as well, but Maithili also joins in on this discussion. And Maithili, yesterday's moves aimed at helping the PNL, today's moves, I mean, what Supriya is speaking about, as and when it happens, aimed at helping the balance sheet as well, seems to be an all-out effort to ensure that the sentiment improves on the banking space.
Absolutely, because actually what has happened right now is that banks' balance sheets have taken hits on two accounts. One is a sharp increase in the yields, which has, as a result of which their treasury portfolios have suffered a huge loss, which is why we saw the RBI allowing those concessions in the held to maturity, etc. The idea was that banks need not make certain provisions, they need not mark to market their portfolios, their investment portfolios, which would have taken a severe hit at the moment, thanks to the sharp changes in the yield that we've seen. The second hit on bank balance sheets has been on account of the sharp increase once again on non-performing assets, because the slowdown in the economy, because banks had lent large sums to the infrastructure sector, especially in the days immediately after the financial crisis, because we do not have any term lending institutions at the moment. Private sector banks had shrunk their lending, and the Finance Ministry was eager to see that economic activity in the country did not come down. So they had put immense pressure on banks to lend, particularly to infrastructure sector. All these loans today in a completely changed scenario because of the issues that we've seen on land acquisition, environmental clearance, or as a result of all these, we've seen infrastructure projects running into problems, as a result of which non-performing assets in the balance sheets of banks have gone up sharply. For the quarter ended June 2013, NPAs of banks have shot up by 12.02%, though as an overall percentage, non-performing assets are still fairly manageable, less than 4% of gross advances. The sharp increase in non-performing assets, particularly in the case of public sector banks, has been a cause of severe distress for the government as well as the Reserve Bank of India. If provisioning, unfortunately at this particular point of time, the Reserve Bank of India had also appointed something known as a Mahapatra committee, which had actually recommended that we need to bring our provisioning norms. That means the amount that banks set aside in case there is a hit because of these non-performing assets. The Mahapatra committee had suggested that we need to bring our provisioning norms in line with international standards. So beginning June 2013, the Reserve Bank actually had asked banks to tighten, that is to increase the provisioning that they had for these non-performing assets, particularly in the case of restructured assets. So now that the government and the RBI, if they bring out the circular, these tighter norms will not apply. There will be some relief for banks as far as setting aside, making provisions from their profits for these non-performing assets is concerned. So together with RBI's regulations yesterday, the changes that they have brought about yesterday in the mark-to-market, the hold-to-maturity portfolios of the investment portfolio of banks, along with that, if we see this also happen, banks will certainly get a fair amount of relief on their balance sheets. So I think a lot of the risk aversion that we're seeing in banks will disappear, and banks will also be seen in less adverse light by investors.
Stay with us, Maithili, but Supriya, just wanted to come to you because you did mention this is certainly double-edged ammunition. Given that it's the Finance Ministry and the RBI, how soon can we see this take place, and is it likely to be a smooth process, or are we likely to see some more amendments?
No, I think this is going to be a smooth process, and contrary to popular opinion, it looks like the RBI and the Finance Ministry are together working, and there is a meeting of minds on many such issues, and even some of the recent measures by the RBI really have the buy-in of the Finance Ministry. In fact, this one such move is perhaps being pushed by the Finance Ministry itself, and the change will be seen in the next 2 to 3 odd days. Remember, banking has taken a whole lot of hit, not just in equity markets, sentiment-wise, but even as far as the macroeconomy is concerned, the worst pain is perhaps being felt in banking. So we expect these changes to be made in the next 2 to 3 odd days. We've been given to understand that the Finance Minister and his top bureaucrats have had many rounds of meetings with the bankers, with the banking secretary, with infrastructure companies and captains of the industry to push through this norm, and we expect the decision to come in shortly on that. I have a question for Maithili. She's still with us. Maithili, you seem to suggest here that banks will be in a better position to absorb the hit if it were to be later. Should one presume here that this is just being done to avert the pain for some more time, or will this subside the pain for good?
Well, the idea, I think, is to give banks some breathing space, because the fear is that if banks take a severe hit, then they will be reluctant to continue their lending for infrastructure projects. And today, with the private sector not lending, we do need to see investment happening, particularly in infrastructure. So with this, if banks are reassured that they will not take such a severe hit on their profit and loss as a result of these relaxed provisioning norms, then they might not be so averse to lending. So lending might again pick up. And that I think is a real hope, because if banks have to make huge provisions, if NPA is right, then you will find banks becoming very risk averse and not willing to lend. And that's the last thing you want to see right now.
Maithili, the other question was yesterday's verdict was that yesterday's moves seem to be pushing the can further down the road today as well. This does reduce the transparency of the bank books for sure, as and when it does happen, as were yesterday's moves too. Do you think the sentiment meaningfully changes by virtue of these moves, or people take it with not just a pinch but a bucket full of salt?
Well, to be very honest, a lot of these provisioning rules, etc., are fairly subjective. So there is, I agree, there is a certain price to be paid in terms of lack of transparency. But the fact is that, all central banks do this, and our provisioning requirements were not really so strong in the past. Over a period of time, we've been trying to bring it up to date and bringing it more in line with international norms. So temporarily, I think if we take a step back, it might help sentiment, because to be very honest, very few people understand the intricacies of the changes in provisioning norms, etc. So they go by what banks announce as profits. So they're not going to see, are these profits because of changes in the provisioning norms, etc. So I think it buys time. Yes, there is a certain price to be paid in terms of lack of transparency, but I don't think that is too much of a price to be paid at the moment. Right now, the need is to get banks to lend again. So if you give them a little bit of a breather, I don't see too much harm being done.
Supriya, just a question to you really. Mentioned it at the start when you broke this news first, that this will also prove to be a bit of a breather for the infra companies, because the banks will now, if indeed this goes on smoothly, will now probably be able to restart lending to the infra companies. Did your sources speak that even this was a possible motive behind this?
Oh, absolutely, and which is why I've been saying it is a double-edged ammunition. It does not just take care of the NPAs on the bank's balance sheets and tries to arrest them, but it also helps kickstart a lot of infrastructure projects. In fact, numbers that have been pointed to me by top sources in the Finance Ministry amount to 1.5 lakh crore rupee worth of projects will benefit from this one overhaul alone. So projects that will need one-time restructuring in their loan life cycle will perhaps benefit from this, and these are projects worth 1.5 lakh crore rupees. So I think infrastructure investment is very much on the government's mind when the government does try to do something with a circular that the RBI is likely to bring about in some time. But that's also the question that I'm tempted to ask Maithili. What has really pushed the government to bring about this change? Do you think it has more to do with the worsening balance sheets of banks and we want to avert a crisis there? Or do you think this has more to do with the whole investment-led growth and that's taking priority? Because infrastructure projects kickstart will mean that investments will flow in. Investments flow in will mean that there will perhaps be growth, the elusive growth that we've all been talking about.
Well, Supriya, I think it's a bit of both. You want to protect the bank balance sheet as far as possible because remember, Basel III also kicks in. So banks will require more capital, and if their profit and loss keeps coming down because of provisioning, then the government will have to think in terms of putting in that much more of capital. So yes, there is a desire to protect balance sheets of banks. At the same time, I think there's also a desire to see that investment projects continue, and investment, does happen, particularly in the infrastructure sector. But if you think of what are the factors behind holding infrastructure investment back, it's not really bank lending. It's more the requirements in terms of, land acquisition, environmental clearance, various permissions at the grassroots level. So these issues really will not get solved. So I think you need to move simultaneously on that also. Otherwise, we would just have bought time and for no real purpose. So having bought time, we need to get cracking on the nitty-gritty of getting these projects moving once again.
Okay, we have a banker with us. Stay on, Maithili, stay on, Supriya. R.K. Bansal, ED of IDBI Bank, joins us right now on the show. Mr. Bansal, thanks for joining in. Just to fill you in, this is breaking news on ET Now. Exclusive sources tell us that there is a possibility that there will be change in restructuring norms. The RBI and the FinMin may allow one-time restructuring of infra loans without provisioning, and restructuring is likely without provisioning for projects delayed due to extraneous factors. Your initial comments on the same?
You see, there are concerns on delays in infrastructure projects, certainly. And there are concerns that some of these projects may need restructuring because of the delay, and some of the delays are beyond their control. But RBI has earlier allowed some more time, like say instead of 1 year, normally in infra it is allowed for 2 years. But in this case, I have not seen the detail, but if it is coming without provision, certainly it is a good thing for banks because many of these projects are viable and they need some more time to be completed and all. And many of these projects, the regions are beyond their control.
Bansal, we do understand that they are likely to allow that one-time restructuring, just to repeat, of infra loans without provisioning. Now, given the recent hit that the overall banking sector has seen on account of the rise in yields as well as the pressure coming in on the NPLs, do you think that this is one major step in the process to at least spur lending to kick off and to overall change the sentiment here?
That's a slightly different issue. I mean, as far as the lending to pick up, in that case, we have to see the projects which are stuck up and which are under implementation. Because the projects which are under implementation, if they are already achieved financial closure, then disbursing of those loans after sorting out these issues about restructuring will not lead to fresh funding. But of course, wherever the disbursements have got stuck up, the disbursements will happen. So, and then as far as the new projects are concerned, this issue may not be relevant